Welcome guys to Professor's Opinion. And this video is gonna be pretty short. I just want to, do a part two version on the gold market. So I already made a video on the gold market and I gave my forecast a few days back, but I guess I missed a few points I should have explained in detail. So I'll do that in this video. So for those of you guys who don't know, I'm an ex-trader. I am also the CEO of Quant Tiger AI. And the link to that company's LinkedIn page is in my YouTube channel about section. And yeah, so I'll go through I'll just share my screen to show you guys what I mean. And yeah, so basically, these are some of the charts that the Quant Tiger AI posted this week. So this is an interesting one. This is a table. So it talks about the largest gold market crashes throughout the last 1 century, I guess, few decades. And yeah, you have the 80s, you have the high inflation, high interest rate hikes, you have the global recovery, risk asset rally, and then you have central bank sales, oversupply, right? Global financial panic, and yeah, QE taper expectations, and then 2025 dollar surge. Technical selling panic. So the largest decline happened in 65 with the high interest rate, right? Making gold basically pointless to hold. But the chart I wanted to focus on today is this one. So this is the COMEX gold futures chart. And wait, let me just see something here. Wait a minute. Okay, so this is the COMEX gold futures chart. And yeah, so I'll just choose a color. So as you can see, long position is the blue line, short positions, red line, gold price is the green one, right? So we are seeing price at all-time high right now. The I want you guys to focus on this. This is the difference between the long position and the short position, right? So the recent rally in gold, it began, toward from summer, around summertime. Let's look at, so this is what the difference was. I'll use another color to make it more clear. So this was the net long position, right? Long position minus short. This is the net long position just when the rally started. And this is the net rally long position right now. Obviously, the net long position is now a bit larger. But what's interesting here is if you go back to here, for example, look at this. The net long position in November 2024, 250 grand minus around 50 grand. So you have 200K net long. And let's look at here. So you have, close to 200 and you have here close to 50. So you have 150 grand net long right now and you have 200 net long. So I'll just use another color to make this. So here you have 200K, right? Net long. This is last year, November. And right now you have around 150K net long, right? But what's interesting here is that look at the price. The price in November was around 1,960, right? The price now is 2,100. And that's a big jump, even though the net long contract went down, right? Compared to last year, November, and right now we're edging towards November. So what's going on? Like it's a pretty obvious ask, right? The long positions on the gold has been around since the COVID crash, and they're unwinding now, closing them up in order to avoid getting physical delivery, which is hassle if you don't close the long position, right? And So yeah, the net long contracts have gone down in the last 1 year, but the gold price has gone up. How do you make that sense? So I guess the easiest way to make that sense is wait, let me just undo all this stuff. So Control C, Control C. Yeah. Okay, so the easiest way to, I guess, explain that is this chart that Quant Tiger released today. So it's an interesting story. Gold market EBITDA spreads are at historic highs. Yeah. So this is where things get a bit interesting. So you have the net long positions on gold actually decreasing year over year right now. But what you have even more interesting is so the beta spread is this dotted line, right? Look at the beta spread right now, bid ask spread. So that's the difference between the buy and the selling price currently. That difference is now at all-time high in the last 10 years at 1.8%. So basically, if you buy and sell a gold contract instantly, technically you're supposed to make 1.8% loss is basically what that's saying. So it was less than 1% in 2015. So the beta spread is bid ask spread is at all-time high. And that is one of the major factors behind this recent gold rally. The people who are bidding for the gold versus the people who are selling, asking for a price for the gold, they have, how do we say that? Um, it's a divergence. And here's what's a more interesting. So this is the gold market liquidity chart focused on, right? So you have the CME futures, liquidity, volume, right? You see it's going up, rising, rising. I'll just get rid of this line. And yeah, OTC market, volume going up, gold ETF market, volume going up. Obviously, though, OTC market is the biggest volume. So the liquidity is rising, which is supposed to bring down the beta spread because now you have more traders, more volume trade, more trading. That's supposed to bring down the beta spread, but the beta spread is actually increasing, which is odd. If you have that much liquidity rise in the market over the last decade, your bid ask spread is supposed to go down, as any professional trader will tell you. So what I believe is happening is a lot of these bid ask spreads are being done by, in my opinion, insiders to basically make money on their long contracts that they have unwinding right now. And yeah, I mean, I just don't get it because the people who are bidding for that gold and the people who are asking for a price for that gold, the difference should not increase to 2%. Okay? Because people who are asking price for the gold are should be willing to sell that gold. And people who are bidding for that gold should be willing to buy. But at a 2% bid ask spread, I mean, that's a lot. If you guys think about it, gold market doesn't move a lot. Okay? Like this year, the biggest crash in gold market was 6% in 1 day. Um, a 2% spread is a lot for a gold market. And so this spread basically tells me that the current price inflation in gold is being done artificially to some extent, through some, mafia gang of traders who are just, bid ask, putting their own bid ask and trying to do trades at 2% difference bid ask, basically. Otherwise, I just don't see the point why bid ask spread will be at an all-time high when the liquidity is at an all-time high. So yeah, this is an interesting point. And yeah, um, I'll just get rid of that. So yeah, if you're wondering why the net long contracts are all the way down from last year, but the price is going up, it's because of the beta spread. Okay, it's a 2% difference. So what does that even mean? If you guys, I mean, I'll just stop sharing the screen now. Fundamentally speaking, the bigger the spread goes, the less trading there's supposed to happen. The more people are willing to hold the position and rather than sell it shortly. So, but the liquidity, the trading volume has surged. So it doesn't explain. The only way this can be explained is the people who are bidding for the gold mostly are from emerging markets and from the global south. And the people who are getting asking for a price for that gold are mostly um, middle class people and the Western world who are trying to sell some of their central bank reserves and middle class people around the world who have gold to sell. And so they're asking for a 2% on average price above the bid ask of the market. And yeah, so they're bullying up the price, bidding up the price by doing this. But there are no fundamentals to basically, how do I say, they sustain this gold market rally. So what I think you'll see is another rally, another after this gold correction is done with, we'll see another rally, a short-term rally before the eventual major crash happens, most likely next year. So yeah, that's it for this one.